Good afternoon, everyone. We are so pleased and blessed to be here and to have you here with us, those online and those here in the sanctuary. We welcome you to our first session of 2025, Paul Quinn, the Paul Quinn Federal Credit Union, and Woman to Woman, Inc. First, I'd like you to hear from the director of the Paul Quinn Credit Union, our own Sister Peggy Brown.
Good afternoon, and we're so glad. This is the culmination of a dream come true for Paul Quinn to partner with Woman to Woman to bring this financial workshop to you. Paul Quinn has been servicing Macedonia AME Church and its family members for over 45 years. Robert Kiyosaki said, it's not how much money you make, it's how much money you keep. And we're going to help move you forward today with this financial workshop. I'm super duper excited, and I hope you all are also.
Yes, we are excited about it. First, let's bow our heads and say a word of prayer. Dear Heavenly Father, we meet here today to ask you to bless the gathering of your people who are in need of information to help us to manage our financial affairs. Bless the presenter and open our hearts and minds to receive invaluable information. We offer thanks to you, dear God, for this opportunity. We ask this in your holy and precious name. Amen. Again, it is my pleasure to be a part of such an important workshop. Woman to Woman has touched many lives since its inception in 1998 by its founder, Marion Brown, who will speak to you at the end of this workshop. Woman to Woman serves the community and the church. There are many things that we do in terms of helping, especially women, everyone, but especially women. We have a tutorial program. We are now happy to begin again the Rites of Passage mentorship program. We have done things in terms of health. And today we thought it not robbery to present to us things that we put aside and we put back and we say we can do that later, it's not important. And so we have found the person to present to you who was highly recommended. You will be extremely pleased and you will be wanting more and more from this young man who has a wealth of information to share with you. I will read his bio that he sent me just a few minutes ago almost. Now I can't quite find it. Oh my God. Oh, I've got it, I think. Darren James is an American-born native of St. Martin in the Dutch West Indies. He is currently celebrating his 10th year as a financial advisor with Northwestern Mutual, Western Massachusetts, located in Springfield, Massachusetts. Darren is in his 8th blissful year of marriage to his college sweetheart of 18 years. They met at American International College in Springfield, Massachusetts. They are the proud parents to twin 5-year-old son, Cameron, and daughter, Kaya, and an almost 2-year-old son, Caden. Darren is an active member of the St. John's Congregational Church in Springfield, Massachusetts since 2010. Darren currently serves clients across the United States, serving almost 600 households on the approach to 100 unique individuals with various aspects of their financial planning. Darren's passion and commitment to planning stems from losing his own father and living out the reality of what incomplete and fragmented planning does to families. In addition to his work as an advisor to his clients. Darren is also a growth and development director, helping to attract and develop financial advisors to the industry. Darren is a certified trainer for Northwestern Mutual and hopes to impact some families and communities through the advisors he helps develop and serve, in addition to his own clients. Darren is also the treasurer of the Martin Luther King Jr. Family Service Center, a board member of the Martin Luther King Jr. Charter School of Excellence, and the vice president of the African American Female Professor Award Association, all in Springfield, Mass. Please join us in welcoming our own Darren James from Northwestern Mutual. Hear him.
Good afternoon, and thank you so much, Ms. Annette, for that warm introduction. It is a blessing and an honor to be with
Darren,
you.
we don't hear you. Your mic is off or ours?
Maybe on your side. Stand by. Do I have chat? I'm gonna
1 minute with us, Darren.
No problem.
Testing.
Testing 1, 2.
Sorry.
No worries. No worries. Perfect. Thank you, Zoomers, for confirming. Gonna stand a mic check. Okay. Let me see. There. Word. Perfect. Thank you for my folks online confirming you can hear and see. Just waiting on the all clear from the sanctuary. We had it a few minutes ago.
Test, try.
Mic check 1,
Darren?
2. Mic check 1, 2. Nothing yet? Okay. I'm going to randomly speak and see. Everybody online, I know you can hear me. We appreciate your patience and apologize for the minor tech trouble. Such is the nature of hybrid meetings. Standing by. Here it is. For those of you that are on Zoom and you may be wondering, we're just awaiting, we're having a minor tech issue in the sanctuary where they're not able to hear us. So bear with us momentarily. And I'm going to do what I do best, which is a little MacGyver situation.
I think it's now. Yes, the
Yes,
devil's.
we're live?
Yes.
All right,
Welcome.
fantastic.
Let's give a hand.
Fantastic. So
Louder.
count it a blessing to be here with you, and thanks everyone for your patience as I shared on screen. No,
Darren, we need volume.
Hold on.
okay, standing by. Almost there.
Can you talk one more time, please?
Sure thing. Loud and clear. Let me know if we're good. Now we're gonna bring it down. Now we're gonna bring it down. Sure thing. I'll keep talking. Let me know once we find an appropriate volume, and we'll count it good. I'm getting some nods. I'm getting some nods. Let me know when volume's all clear. All right, fantastic. Well, I think like anything good, it starts with a little bit of trouble, right? And I won't count myself a pastor, but I think just like a good sermon, it takes a little bit of warming up. So I'm glad that we had our warm up out of the way. So, woman to woman, Paul Quinn Federal Credit Union, Miss Annette, Marion, uh, everyone, thank you so much for hosting and for having this. And I count it a blessing to be with you. I recognize first and foremost that I am not a woman. And I certainly appreciate, though, the ability to share with you today some of what we've been able to do over the last decade with our clients who coincidentally tend to mostly be women. And as I reflect on this opportunity and how God put all this together, I always feel compelled to share my story on how we've arrived here. So as Miss Annette mentioned, I started in financial planning about a decade ago this month. And for a few years prior to that, I had been casually helping some folks with some things that I had learned on the way, on the sidelines, on my own, because I didn't have my own financial advisor. Uh, and I was compelled there because I lost my dad very suddenly on New Year's morning of 2008. And what stood in the wake of his sudden passing was the strength of my mother, the strength of a woman who stood there, and though she had entrusted her husband for 35 years prior of marriage to run it all, run the finances, run the household, at least that aspect of the household, there she was at 53 years old, a widow. There she was unexpectedly raising three boys, one in college and a grandson who had suddenly become her fourth son at less than 2 years old. And with strength, resilience, and poise, she rose to the occasion. She stood firm, she stood unwavering, and she stood tall. And forward she marched to get me through school, take care of my siblings, and get us launched from our home. Continues to be the backbone of the family and the matriarch of an entire generation. And so I don't allow that to go by me without recognizing how God put this together. And so I use today in sharing with so many of you strong women to honor my mother, who is, with us still and continues to be a strong matriarch for the family. As we dive into conversation today, first, let me say that the things that we're going to share with you today, first and foremost, I hope that everybody's able to take away at least one small thing, be it for you or for someone else. It may be somebody who is your junior, right, along the way, and you look back and say, if I had known this 10, 20, 30, 50 years ago in some instances, oh, what an impact I think it could have. And so that is my hope and my prayer as we embark through the conversation today. Reaching your new level of financial confidence is what this first seminar is all about. And so we're going to do a broad overview of things that we make sure we think about when we think about planning across the board. So I first begin with asking you, what would you like to accomplish in the next 3 years? And let's take a moment to think about that, because I think one of the first pitfalls of good financial planning is that everybody gets focused on these really big, far out goals. They stay focused on these intangible things, and then the doubts start to creep in, the worries start to creep in around like, well, is that really going to matter? I don't know if that's even real. I don't know what the future is going to hold. So why am I worrying about so far out right now? So let's bring it back. Let's pull it in and just let's take a few seconds here to think about and write down, what would you like to accomplish in the next 3 years? And you don't have to share this, right? It's just for your quiet reflection. Let's take a moment. Now, as you write and reflect, the underpinning of this is that being able to articulate your goals and how important each one is to you is the most important to help you make the best financial choices so that you can reach your goals. So as you look at what's on your sheet, I'd ask you to consider, where are you in terms of being on track to your highest priority goal? That if the good Lord called you home today, you would go, hey, if I just got this one thing done, I would feel okay, right? Because I know I can't maybe get it all done, but I'd feel okay about getting this one thing done. Now, if you aren't on track or you don't have a plan, that's okay. That's why we're here, because more than 6 out of 10 Americans say that their financial plan needs improvement, right? It's actually a little closer to 2/3. And Northwestern Mutual, we conducted a study in 2023. We do this on an annual basis. We're about to publish our 24 results, but only 37% of Americans identify as having a financial advisor, right? 37%. So no surprise that there's a correlation there. 2/3 of people think their financial plan need improvement. Only a third of them are using a financial advisor. So when we think about planning, I think that what's really important, whether you're doing it, with a firm like Northwestern Mutual or anywhere, is that you think about the big picture. It's about focusing on everybody's first goal is always, hey, I want to grow my wealth. I want to figure it out. But a lot of this starts with protection. And one of the things that, we were blessed, even in the tragedy of my father's passing, to have accomplished was that they had protected what mattered to some degree. They had done some estate planning. And so at my father's passing, it was very clear, and we had very clear instructions on what needed to happen, how it was going to happen. There were beneficiary designations on bank accounts, on life insurance policies that were not outdated, and so didn't create a lot of complexity in the grand scheme of things. And so as we embark on this journey together, this is something important to think about. Protecting what matters is the fundamental starting place in the planning journey. And then as we talk about growing wealth, well, maybe it's someday you want to open a business. You want to go back to school. You might have a big family event or a series of events if you're in my world. I think about the years upcoming. We've got my mom's 75th birthday, my 10th wedding anniversary. My children are going to be turning 10, my father-in-law turning 60, my mother-in-law turning 60. So there's a lot on your mind of things that you want to accomplish and be prepared for. All of those things are relevant in terms of financial planning. And where I think a lot of us get turned away from planning is we think it's all about chasing returns on an investment. We think it's all about just, hey, how do I make as much money as possible? What is it tied to? Look down at that paper again. What are those big three goals that you want to have accomplished? You are unique, and so are your circumstances. And so we want to make sure that as you plan, the things that you are planning for are connected to those goals and that we're working together to help you accomplish them effectively. And it's going to evolve. So, show of hands. How many of you have had at least one of the things on your paper or on your mind for 5 years? Show me your hands if it's been on your paper for 5 years. How about 10? Longer? Shorter? All right, so good. So you guys are thinking in the near term. So that's really exciting that it hasn't been around for too long. So some of these active things, just remember that plans are going to evolve, right? And as you think about that, planning isn't this one-time thing that we do and then we put it on a shelf. We go, I did that. I built a financial plan once. It's something you should be revisiting, and having an active relationship with a professional is really important so that as your plan gets updated, or as your life, is updated, that you're updating your plan. Same way when you go into the bank or to the credit union, right? They're going to have new products and new services and new things to offer you, and they inquire what's going on in your world so that those things that may be relevant as the banking relationship is evolving, so too should your financial plan. So another question, a reflection moment here. What things are you worried about that could change your upcoming financial plans? Go ahead and write those down for me. Just name one or two things that you're worried about that could change the plans you've got. And let's test the acoustics on the other side now. So in the sanctuary, and feel free for my folks on Zoom, go ahead and either put in the chat or unmute yourself and go, what are some of the things you're worried about today that could change your plans? Yeah, in the sanctuary, go for it. Annette, could you relay for me?
Oh, loss of income.
Loss of income. Okay,
Yeah.
Great. What else?
Death.
Death. Yep, loss of income, death. What else?
Birth.
Birth. Absolutely. Yeah, and considering everybody in the room, I think it's birth of not just children, but grandchildren, right? And even great-grandchildren in some cases, and how that impacts the family. Yeah. So yeah, these are all great things. I've got some from the Zoom chat coming in. State of the economy, right? What's happening around us and how we react to that. These are all really important things that lend themselves to your financial plan needing to get updated and the impact that those things have. I also think about, we think about loss of income, we think about death, But think about what happens as a community and as a family when something happens to somebody in the circle, right? And you or the community are jumping in. So it's a family member getting sick, somebody getting so sick that now you're adjusting your home and bringing in a parent to come and live with you, or a child that has gotten ill and lost their income and they can't quite make it on their own. So these are all things that we think about and go into adapting your financial plan. So let's start with the fundamentals. How we think about building a plan effectively and how we challenge you to do the same is one, protect what matters the most by managing the risk. And you all just shared some really great first risks, right? To any good financial plan. You could be a self-made millionaire, right? And there are risks to your planning. And then we'll talk about how to grow the wealth, right? And then lastly, the protection piece. So estate planning being really a fundamental part of it. And so we'll round up the discussion there. So when we think about protecting and managing the risk, right, this really relates to your ability to reach your goals so that no matter what's going on around you, state of the economy, you didn't see an accident, didn't think an illness was ever going to happen to you, that you're okay. And this is not the fun stuff. So because I'm going to start with the heavy stuff, right? Because I believe in eating the frog first. Nobody likes to think about any of the negative, but it's the most important aspect of planning. And I would tell you, frankly, my conviction around planning is here because had my parents dealt with this hard stuff, I may not be standing before you all today. I had a very different plan for my life, right? And I know I thought I had a plan, right? We plan, God laughs. I thought I had a plan for my life that was going to be very different in reality. But when my dad died and we didn't have enough life insurance in place, right? And we had to pick up from where we were, it changed everything. So number one, I encourage everybody in line with, your current banking relationship at the credit union or elsewhere, setting up an emergency fund. Now, what is an emergency fund? Well, as it sounds, making sure you've got liquid cash. It's not tied up in a CD. It's not tied up in anything that's going to have penalties or expenses or charges to get out of it. It's just safe cash, not under the mattress, right? Secured in a bank, insured by the FDIC, that allows you to pull on it in an emergency. We recommend that you keep somewhere between 3 to 6 months of expenses in an account like that. Now, that's not something that is built up quickly for a lot of folks. So give yourself some grace here. We encourage our clients to take somewhere between 2 to 5 years to gradually build up their emergency fund, because along the way, it's going to get hit, right? The water heater is going to go out. The carburetor is going to need a change. Something's going to happen, but those are the moments where you want to have cash available to tackle those things instead of sticking them on a credit card, right? Where interest rates today can be as high as 30 and even 36%. If you're a newbie to the credit world or you've had some mistakes in your past and you're trying to earn your stripes again, right? Those interest rates can really slow down your growth. Or, as I see a lot of clients doing, unfortunately, is dipping into their retirement savings before they're eligible. So before 59 and a half for some of the less seasoned folks I see in the room, right? But even when you are above 59 and a half, there's things that you have to think about and why you want to have some liquid cash instead of just tapping into things like your retirement account. And it's taxation. A lot of times folks end up going to their retirement accounts, but that money that they've saved, and we'll talk about this some more in a little bit, is all money that is yet to be taxed. And so every time you go drawing on it, you go, oh, well, if I need $10,000, it's going to cost me more than 10 to get it because I've got to think about the 20, 25, 30% tax bill that's going to come with it. So when I get on the phone, I just kind of go, well, I roll my eyes and go, okay, fine. Well, how much do you got to take out of the account to get me what I need? And they say, well, it's, 13, 14, 15,000 to get you the 10 that you're asking for. And you go, oof, All right, well, I guess I got to do it. So having a good plan for an emergency fund can really help mitigate some of those risks and expenses and giving away your hard-earned dollars back to Uncle Sam and the state of New York sooner than you may have wanted to, right? So think about that as your first pillar of a good financial plan is setting up an emergency fund. And I'd encourage you, if you don't have a savings account, to start there. It shocks me, frankly, still after a decade and thousands of client meetings, how many times I meet a nice person and they are sitting on a boatload of cash in their checking account. Now, here, first thing, this is a security risk because you go swipe your debit card at a gas station or somebody does something negative or they get a hold of a copy of a check, even with all the good security protocols in the banking world, there's bad actors out there. And if most or a large portion of your wealth is sitting in a checking account, somebody has a beeline straight to that money, right? That sometimes, even again, good banking security measures, they can get around. I just had a young client, nice young lady, lose $9,000 of her money, right? That she had sitting in an account. And after the fraud detection and the bank investigation, the insurance company only gave her back 5,000 of her dollars. So there she was, out $4,000 of her money that she had scrimped and saved and worked hard and wanted to do something with. Gone. So get money out of checking accounts, get them into savings accounts. They are insured, their security protocol. Now, I'm not suggesting that they're not subject to still being at risk, but it's just an extra layer of protection. You separate the dollars, is security first, and then it also gets you a better interest rate. Right? So talk to your banking institution about how you can maximize the interest rate that you're getting on your savings account. Because the standard savings account rate, can be as low as 0.01% at some banks still, right? And so it's worth having a conversation with your banker because they may have options for how to help you improve that over time. And credit unions are a great place because they are rooted in community and all about getting you more, right? So they can do better in the community than some of the big box banks around the place who you're just a number, right? And you're just a way for them to make money and charge a fee. So I encourage and appreciate Paul Quinn Federal Credit Union for doing this and the philosophical alignment that we have long term. So emergency fund is number one. Next, let's talk about, you've all mentioned protecting income. I believe professionally and personally, this is the biggest risk to a financial plan. And again, I know I've got a mixed set of generations in the room. And so protecting your income is a two-sided coin. While you're still working, protecting your income is all about doing exactly that, right? I have a good job. I know what my salary is or how I can calculate my earnings. And if I keep this job or something like it for the next 10, 20, 30 years, that's how much money's on the table. So think about that for a minute. If you're earning $75,000 a year before taxes today, and you still have 20 years in front of you of work, without getting fancy and doing any inflation calculations, like let's just do straight math. If I make 75,000 a year for the next 20 years, how much money am I going to make? $1.5 million of incomes coming my way. Now, if you ladies had $1.5 million sitting in any account, wouldn't you protect it? Wouldn't you want to make sure it's got every safeguard imaginable? You are your biggest asset. While you are working, that is what your potential looks like. And for those of you that may already be retired, protecting your income in retirement, similar. Well, you do have the nest egg, or you've got the pension that you know, hey, I'm never going to outlive this thing and that money's coming. But what happens if I do start to get ill? What happens if I do need a little extra help? And now my expenses are going up. How do I make sure that I've got a plan in place that isn't going to bankrupt me or isn't going to leave my family with nothing, or I have to sell my house, or I got to move in with family to continue to afford some dignity, frankly, right, of aging gracefully. So thinking about while you're working, disability insurance. Now, there's layers to your disability insurance that we'll talk about, and then we'll talk about long-term care. And then the last piece is protecting your loved ones. The big fear we all have. Everybody, frankly, my opinion, should own life insurance until you don't need to. But in almost every situation, you can make a case for why life insurance is important. If you are in my generation, right, under age 40, with young kids at home, then life insurance is really important, because if I don't wake up tomorrow morning, I want to know that my wife doesn't need to go find a new Darren 6 months from now to continue to afford the life that we've been working hard on, right? Like, I don't need to know. I need to know that there doesn't need to be another guy in my kid's life because of what we were building that I didn't follow through on, right? So when you're young in your life, it's about continuity of what you've been building and what you're anticipating you're going to give to your family. But there's an evolution. When you get older, you're looking at your life insurance and you start to ask, like, what I got all this life insurance for? I got money in the bank. I got retirement accounts. This mortgage is close to paid off. If something happens to me, they could just take the money out of the investment accounts. They could just sell the house. They could do those things. And that's true. But I'm going to bring us back to one fundamental truth. Taxes. Taxes exist in America. And the government finds a way to always get their hands on some of your money. Life insurance, all forms of life insurance at death, are 100% income tax free. So when you pass away, even if you've got a big pile of money in an IRA account, right, or a retirement account, and somebody besides your spouse is going to inherit it, well, you're also giving them an inheritance riddled with problems, because they have to take that money out within 10 years. Those are the rules today. The rules used to be they could stretch it over their lifetime, but that's not true anymore. The government now says, hey, you pass away and your child inherits your retirement account. They've got 10 years to liquidate that account because we want our tax money. That creates a problem, especially if you've raised successful kids who are doing well, because they're already feeling the pains of taxes in their own income. And then now, mom, God bless you. Thank you for leaving me something. But Lord, could we have figured out a way for me to not have to eat these taxes and give up more of your hard-earned money that you didn't get to enjoy to the government? And however you feel about how they spend it. So life insurance solves that fundamental problem, because the day you pass away, a tax-free check, well, not exactly the day, but after you pass away, within short, a tax-free check shows up for your loved ones, and it can either slash the tax bill down, in essence, because you've got options. But most importantly, and particularly in our community, I think the thing that we hang our hat on sometimes is, oh, well, I got a life insurance policy, or I got money in the bank, right? Do you want to sit on ice for 2 or 3 weeks and not have your services because you're waiting on the life insurance company to process a check? Do you want to be sitting around waiting and having your family go through probate and having creditors look at and see, oh, well, can we get any of Mr. So-and-so's money or Miss So-and-so's money? And your family's waiting in the wings for, in Massachusetts, it's up to a year that your account, your estate has to be open before it can get closed. Life insurance solves that problem, because, hey, you walk into the funeral home. Did the deceased have life insurance? Yes. Great. What's the policy number? They know they're getting paid. We will process everything here and now for you. No problem, because we will make a claim to that life insurance check and make sure everything gets handled. And the dollars that show up, you don't have to pay tax on them. It's a beautiful thing. Life insurance is truly like magic. So digging into each one of these. So income protection, like we mentioned, the reality is 1 in 4 people becomes disabled at some point in their career. Now, hear me good on this one, right? As my pastor would say, listen to me with your good ear, right? It's not that you're going to become disabled for the rest of your career, right? But 1 in 4 people experience some form of disability. On average, a disability lasts about 2 years, where it knocks them off their horse. Maybe they can't go to work at full capacity. I've got a congregation member who's a client of mine who she had a stroke 2.5 Decembers ago. And she's back at work now, but she's making half the money she was making before because all of her functionality and capabilities haven't come back, right? And so this is where disability insurance becomes meaningful, right? Income replacement. Most people brush this off, right? I don't need to get any more insurance. I'm tired of paying insurance premium. I got that through my job. Great. And it's great that you have a benefit through your employer. But did you know that your employer benefit has a cap? It has a ceiling that says most employers are 60%. So if something were to happen to you at work, let's use easy math here. Let's say you're making $100,000 a year. Well, you just lost $40,000 of income, even with your workplace protection. Because if you got sick or got hurt, number one, the benefits typically say you got to wait 3 months or 90 days before they start to pay you. And number two, it's 60%. And number three, my favorite thing, it's taxable. It's actually my least favorite thing, right? But it's taxable. So that 60% ends up not really being 60% when the government's done with you. And isn't that the worst time to realize that your disability benefit isn't what you thought? When you need it the most. So if you've got a benefit through your employer, that's great. It's a great foundation for your risk management plan, but it's important to think about, hey, how do I get a little more, right? How do I fill the gap on this 40%? And that's where getting an individual disability policy through companies like Northwestern Mutual or any of, a couple of other great companies really can benefit. The underlying thought is this. Think about your bank account for a second. How many hundreds of dollars, maybe thousands of dollars do you spend a month insuring your car? It's a good looking car, ain't it? That nice house you built. Even your cell phone, in case your grandbaby grabs it and throws it across the room and the screen breaks and now you got to go get another one. It's all insured. But the most important asset, I'm looking at her. She's worth a lot of money and a lot of impact for a lot of people. Why isn't she properly protected? Protecting your loved ones in the event you pass away. So life insurance, again, I'm not going to go into a detailed explanation of, life insurance, but the reality of what we've shared is all true around life insurance planning. Now, here's the thing. How to think about life insurance planning. How much do you need? How much should you have? How long should it be? I don't know. There's probably 30 people here between Zoom and in the sanctuary. There's 30 different numbers of what your life insurance number should look like because it's based on your circumstance, right? But the fundamental truths of how to think about life insurance, if you were to pass away, we want to make sure that everything in your life, all the debt goes away. The mortgage, right? Even if they could sell the house, right? The mortgage should be gone. All the other debt should go away, right? So that it gives your family the latitude to make good decisions, right? I meet lots of folks oftentimes go, well, I don't really have any debt, Darren. I paid off the mortgage. I did all this stuff. And I go, why would I have life insurance? I go, well, let's play that out for a second. Imagine you pass away. You got no debt. You got some money. Everything's okay. But your family goes, we don't really want the house. Or maybe we can't afford to keep up on the maintenance and the taxes of the house, even though mom left it for us or auntie left it for us and we could own it. So we want to sell it. But the real estate market's not in a great place, right? So if they sold it, they would sell it at a discount and you would turn over twice in your grave going, I can't believe I left this to this baby and they did this foolishness to my house, right? So what does the life insurance do? Well, it creates a pool of cash that they could use to carry the expenses of the house, carries the insurance costs, it carries the maintenance, maybe the sprucing up that they got to do to make it not auntie's house or not grandma's house so that a nice young couple could see it and see their family there and buy it for top dollar, right? At the end of the day, building generational wealth is about maximizing what you're getting, right, from it. And so all of those small ways or how you could think about life insurance as a functional tool inside your own plan, right? But we take care of all the debt. The next thing we do is we want to, if you're still working, replace your income, right? Because like I said, I don't want another nice looking fella showing up at my house trying to court my wife, knowing that she also needs somebody to help take care of the family, right? But even when you're retired, think about it. If you and your spouse are living a comfortable but pretty lean retirement, if one of you passes away tomorrow, well, if you got a Social Security check, well, one of those checks is going away. If your check is the smaller check, you would step up to getting the larger Social Security check, but the one you're getting now is gone. And you might argue that, oh, well, I won't need as much. I could live on less. There's only one of us, not two of us. But that isn't always the truth. And in fact, you may have, some of the shackles freed from you that goes, my honey never wanted to travel, but I want to. And now that he's gone, I can do it freely, but I don't have the money to do it. So life insurance in that regard, again, replaces that income stream that you had anticipated had you guys lived all the way to the end together, that now gives you the latitude to still do some stuff and do some planning. So we take care of income replacement. So we got debt, we've got income replacement, we've got education, right? Or what I think of not as education sometimes, but as, enabling. So if you're gone, if you've got young kids like mine, I want to know that my kids can go to college, right? Without the constraints of finances. So you can build into your life insurance planning enough money to say, hey, I would like my kids to go to SUNY, wherever, right? And not have to worry about the financial aid bill. Build it into your plan. Buy the life insurance now. If you pass away early, they got that money earmarked for their education. Or you may want to help the church. Say, look, we've been trying to build this building for a long time. We've been trying to, make a new sanctuary, make a new community center. And I want my legacy to be the cornerstone of that new thing. And you could leave a substantial life insurance gift to your church, right? Or to some other community organization. So when you think about, you're listening to public radio and you hear them talking about these big, fancy, wealthy people, the George and Irene E. Davis Foundation. You go, I wonder how them people got all that money to give away. Well, some of them didn't, but they had just enough to buy a life insurance policy that took their $200 a month, $100 a month, whatever it was, and turned it into a couple $100,000 tax-free when they died. And a different conversation for a different day or for a one-on-one session with some folks is that money then gets invested through financial advisors and it turns into this perpetual legacy, right? That keeps growing and lives generations beyond you could ever imagine, right? Some of the stuff that you hear, the Rockefeller Foundation and the big, big names, yes, they built wealth along the way, but their wealth persists today through some fundamental things like life insurance and trust planning inside a good estate plan. So debt, income replacement, education funding and enablement. And then, of course, the thing we all worry about is, honey, I heard they died and they had to put up a GoFundMe page for that baby. That's a problem. I would make it my personal mission that I don't ever want to hear that from anybody whose life I've been blessed to touch, right? Life insurance doesn't have to be expensive. I don't care how old you are, young lady. I don't care. It doesn't have to be as expensive as you think. There are companies and there are options out there. If it's important in your plan to look at it and understand what your options are, right? Term insurance, term life insurance is what most people have. The same kind you get through work that costs you maybe $1 a paycheck. You could go buy that from an insurance company yourself. And I bought $750,000 of coverage when I was 24 years old, and it cost me $22 a month because I was young, I was healthy, and I was like, I'm scared, right? I was scared because after watching what happened with my dad, right? And so it may be more affordable than you think. So all I would challenge you is don't rule it out. And those four things, right, get handled. Your final expenses should be covered. the box, the hole, the pastor, the party, the cremation, if you so decide you want to do it that way. And then the immediate aftermath of your passing. Think about all the people who would be impacted and can't think straight and can't act right and just can't go ahead. We're in a church. So I'm sure you've all experienced this. You come to a service and you see a bereaved spouse, doesn't matter, male or female, and they are beside themselves in distress. Not just from the grief of the loss, but from the worry and the stress of going, I don't know what I'm going to do. I don't know if I'm going to be able to keep my house. I don't know if I'm going to be able to live after this because they didn't plan. They don't have a plan on what comes next. And then you've gone to a few funerals where you've gone to a bereaved spouse and you go, honey, I'm worried about her because she ain't even crying. Or I heard she cried a little bit, but I would expect her to be a lot more stressed. Well, where do you think that lack of distress comes from? Having a good plan, right? I'd argue it from the life insurance because she goes, I know through my faith in God, I'm going to get through this. I can get through this season. And we had a plan. We got some resources to get us through to the other side. So that distress that comes with loss gets eliminated in a very significant way. So that's how we think about life insurance: debt, income, education, enablement, and final expense planning is how you would arrive at your correct number. And sit with a professional as a follow-up to today. For everybody who's registered, we'll talk about connecting with us and seeing how we might be a resource for you and exploring some of these concepts and connecting you with some of my partners down closer to where you are, because I'm 2.5 hours north on the highway, but God bless Zoom. We could do this however it feels comfortable on getting to that number and thinking about where things like life insurance fit in to your equation. So I want to pause there. I know we had a little delay on our starting time. I want to be respectful of our scheduled time as we transition to growing wealth. What questions come up around protecting what matters so far? Disability insurance, long-term care insurance, life insurance. From the sanctuary first. Any? Okay. And from Zoom, feel free to throw your questions in the chat. And we've got a moderator who will help me with that. Okay. So if there are no questions on protecting you just yet, if one comes up, feel free to write it down so you can ask. We'll leave some time for Q&A on the back half. Let's talk about growing your wealth, right? Now, we talk about protection and how to figure all this out. But what does growing your wealth really look like? Here it is in a nutshell. Right? Can I give you ladies my secret sauce? All right, here it is. Here's how to build a good financial plan. My gift to you. Step number one, we talked about. Set up an emergency fund, right? And have some money liquid in the event of tragedy, in the event of stress, right? So that you can help take care of things. Don't have all your money sitting in a checking account. Please, please, if you do nothing else today, go to the bank on Monday, Sunday if they're open, this afternoon if they're still open, and go move the money, right? Get it someplace safe and someplace that's earning you interest. You ladies are all young enough that it wouldn't surprise me if there's somebody in the room who's sitting on a cool $100,000 cash, just sitting there. I got another client of mine, she's 62. When I met her, she was sitting on about $250,000 of cash in the credit union where she was. And her credit union was not, I would argue, as good as Paul Quinn, because they didn't work with her to help her find any other money, right? Where she could make any forward progress. And they were only paying her 0.03% on her money on $250,000. So do the math on that. If your banker works with you and just gets you to the average market rate today, 3%. If you're sitting on $100,000, okay, that's $3,000 a year of interest that you should be getting. $250 a month that bank is keeping in their pocket and they're not sharing with you. That's a problem to me, especially in our community. So go talk to your banker, and if you don't got a good relationship, you got people in the room who can help you out, right? But short-term goals, have that money on deck. Then let's jump ahead to retirement, because this is where we all really start our financial planning journey, right? Everybody tells you, honey, as soon as you get to work, as soon as you do anything, make sure you save a little for later, for the big pie in the sky that is retirement. And there are lots of different accounts, right? Your 401k, some of you will have a 403b at work. It doesn't matter what it is. If it starts with a 4, what that means is that it's an employer-sponsored retirement plan, okay? Something that you get through your job. And your job might match you. So let me ask you this. For those of you that are actively working and you think you got a retirement plan, if your boss came to you today and said, hey, you want a 3% raise? How many of you, show me your hands, would turn them down and say, no, I don't want your raise. You can keep it. All right, good. I'm glad I didn't see any hands. But when you go to work and you got a retirement plan and they're saying, hey, Annette, if you put away 3% of your income into this retirement plan for your own benefit, we will match you 3%. And if you tell them, no, I'm not doing that, then guess what you're doing? It's just like giving up a 3% raise every single year, because they're not taking it from anywhere else. They're taking their money, their profit, and saying, we're going to contribute this above and beyond your salary to your retirement plan. So if you got a match, or you think you do, or you don't know, ask at work. And if they say yes, you have a match, you have to do X in order to get this many dollars, please do it. I don't care if you think you're going to be there 6 more minutes because that supervisor is making you crazy. Please do it. Because I thought my first career was going to be about a year. I was there for 6, right? Growing and doing. And I was fortunate and blessed to get good advice. And I put my money into my retirement plan. And when I left at 27 years old, I had already amassed over $50,000 of money, right? Only half of which I had saved. The other half was from my employer. It was their contribution to my plan. So don't leave that money on the table, right? And then let's talk about just taxation, because this is really important. In retirement accumulation today, there's a lot of opportunity, right? Things are not the way they used to be even 15 years ago. Conventional wisdom used to be this: hey, open a retirement plan, put as much money away as you can, and make sure that you don't pay the taxes on it today. Because by the time you get to retirement, your income is going to be lower. So you're going to get taxed less. So you should try to push it out as far as you can. And that wasn't bad advice. It was just advice for the time when taxes were higher than they are today. And I know y'all ain't gonna believe me, but taxes today, even with the extension of the current tax plan under the administration, whether you like them or don't, it doesn't matter. It's the law. They actually made taxes lower for most of us sitting in this room for the foreseeable future than they have been historically. And so it's a good opportunity to look at this and say, okay, I know I'm going to have to pay some taxes when I get to retirement. But what you don't want to have happen is you show up at retirement and all of your money still has to be taxed. And talk to one of these seasoned saints in the room who've gone through a couple of presidents in their retirement, and they'll tell you, yeah, if I've been taking out the same amount of money for the last 15 or 20 years, even though I haven't changed how much I'm living on necessarily, I have to take more out of those accounts because the tax code keeps moving. When the taxes go up, if I need to get $50,000 a year out of it, 10 years ago, I might have had to take out 70,000. Today, maybe I only got to take out 62,000, right? So it matters that you have variety in your tax strategy. And the way you do that is by opening up what are called Roth accounts. So a Roth account simply says, pay the tax now, let the money grow. You'll never have to worry about taxes later. So imagine putting money into an account today. Let's just, again, I like round numbers. Let's say we put away $10,000 into an account, some old retirement thing you forgot about. You pay the taxes on it now. The government says, great, we're going to keep letting it grow. And when you go to get it in retirement after 59 and a half, if that 10,000 turns into 100,000, you've made $90,000. Guess how much they tax you on that 90,000? Zippo. Where else you putting away money that the government's not getting their hands on it? Not a lot of places, right? So having that kind of diversification in your strategy can be helpful. And if you're already in retirement, right? You're already in retirement now, there is a strategy called what's called a Roth conversion that would allow you to take some of the money that's in your pre-tax retirement accounts, pay the taxes on it now, and reinvest it. So we're not taking it and putting it in your bank account because you don't need it, but we're just living within the changing tax code and going, I'm going to take it, pay the less taxes. Because back then, when I was working for the state and I was making really good money, taxes were high. And that advice, Darren, that you're talking about was sound. Because if I was making 100 back then, but in retirement now, I got no big bills, the kids aren't here, like I'm living on a comfortable 60,000. Yeah, you're paying less in taxes potentially. So you have an opportunity to push that to the limit a little and go, if I take some of that money out now, the tax rate's lower. When I need that money 10, 15 years from now, I don't have to pay any more taxes on it. And it's a really powerful strategy for some of my seasoned saints as we talk about them, right? Like it's a good thing because you don't know what taxes are going to look like 10, 15 years from now. I don't either, right? But not having some variety and some options creates stress for you that you don't need to deal with. So between your a good tax professional and a good financial advisor, we can help you map out what would that strategy look and feel like along the way. So this is one of my favorite things to talk about, kind of putting the plan together. And along the way, these two buckets in the middle, some of you own some property, whether it's just your primary residence or you might have some investment property. Real estate in America has always been the primary wealth building engine. And it all comes down to what I've talked about today, taxes. Because you buy a house, you sell a house, there's ways that you don't have to pay the taxes right away. And you can benefit from the gain, right? To step up into the next big house. If you sold your primary residence today and downsized because you ain't got a big house full of little kids anymore, and you make a pretty penny on it, you don't have to pay capital gains tax on all of it. I'm no tax professional, right? But the law allows you to keep a big chunk of your money without paying taxes that you could put into whatever you want, right? And that's how you build the wealth. And the money that's sitting in your savings account, 3 to 6 months of expenses while you're working. For those of you that are retired, we encourage you to hold on to somewhere between 3 to 5 years of your variable income need. So if you got a Social Security check that's $3,000, but you need $4,000 a month to live, right? Then you only really need to be taking about $1,000 a month out of whatever other accounts you have to be okay every month. So that means you need, and forgive me, don't worry if you're not a math person. I promise you can follow this, right? If you only need $1,000 a month, 12 months in the year, that's $12,000 a year. That's easy math times 5. That's $60,000. So if you only need $1,000 above your Social Security check to be okay, and you're sitting on more than $60,000 in the savings account or the checking account, God forbid, right? I would tell you it's time to have a conversation with a professional about what else you should be doing with that money because it is not serving you sitting at the bank, right? By itself, right? Your banker can help you with that. An advisor can help you invest that money outside of retirement accounts to get it to really grow so that when you're ready to celebrate your milestone, like my great aunt was blessed to do at 90, she took a cruise with the whole family at 90. I don't know if she paid for it or not. I'm not going to make up stories here, but that she had the latitude to be able to do that at 90. If you want to go celebrate a milestone, you'll have the money to do it without feeling the constraints of taxes and what am I giving up and am I going to leave enough at the end of my life for them to be okay? That's what planning does. It gives you room to breathe and to grow. And we talked lastly about this notion of life insurance. And I think talking about the different types of life insurance in our community is so critical because y'all are from the generation that probably remembers, I don't, right? The life insurance man coming to the door, knocking on your mama's door or your grandma's door and collecting the life insurance premium every week, right? Couple cents, couple dollars, right? So that at the end of their life, you had something to bury them. And our community got sold this notion of final expense insurance. It's a type of permanent life insurance. But in a lot of cases, all it did was provide enough to handle final expenses, and that was it. The wealth train stopped right there. Nobody was burdened, but nobody was given any real lift, right? Permanent or whole life insurance can be such a powerful tool in the wealth building journey for some folks because of the preferential tax treatment that it gets, because it's life insurance that shows up at the end of your life 100% income tax free. And if you're on the younger side and you're looking ahead, well, the reality is it's life insurance. And so for every dollar you give to the insurance company, they're promising an exponentially bigger payout when you die, whether you die tomorrow morning, God forbid, or 50 years from now. And so no matter how you swing it, life insurance is always going to pay out more money than you ever put in. And like that, it becomes magic. And because you get it where you are, it stays for your entire life, hence the name permanent. Whether you live to be 120 or you're gone at 58 like my dearly departed father, you'd have it for the entirety of your life without stress or worry or fear. So putting the wealth building picture together, these are the four major pillars of how we do it. And there's a lot of detail in here, which is why I encourage you, feel free to reach out to us. Happy to have this conversation with you. Reach out to your financial professional and give them an elbow and go, hey, I went to this nice seminar with this good looking brother. And he said, there's some stuff that you ain't been talking to me about, right? And ask, inquire on what the options are here along the way. I'm going to hit pause there again. I want to create some space for questions because I don't want to save it all at the end as the information flows to you. What questions come up around wealth building from any of these avenues? Okay, well, give me a pulse check, ladies. How we doing? Nobody looks like they're asleep, so that's good news. But how we feeling? I hear a good.
What is your whole life insurance?
Relay the question for me, please, Annette.
What is your whole life insurance?
When you ask what it is, can you be a little more specific for me?
What I mean is that,
Take it to her.
there's
Hold on, Darren.
No problem. Thank you.
hello, my name is Dolores. My question is there's a difference. There's a life insurance and a whole life insurance.
Yep.
Term life insurance.
Correct.
And,
Yep.
right. What is the difference? Because I had a term life insurance and it went up to 70. I had it for a very long time.
Yeah. Yeah.
And-
Great question.
And now my money was gone. I've been
Yeah.
like over
Yeah.
30, 40 years.
Absolutely. So this is one of the most common questions I get. And so think of term insurance is like renting, right? It's a long lease from the life insurance company. You say, hey, I'm going to get this while I'm young and healthy, right? Like I shared earlier, I bought $750,000 was my first life insurance policy I bought on my own at 24, cost me, I don't know, $25 a month or something, right? But there's a reason it's that cheap. It's that cheap because the life insurance companies know only 5% of the time will it pay out. Not because they're big, bad, evil companies, but because most people don't die, right? The same way you pay for your car insurance, and if you really think about it, you'd get mad going, I spent a lot of money on car insurance. I've never been in an accident. Why am I paying so much? And how much money have I lost, right? So term insurance is designed to be affordable, to solve the big problems that you have in an affordable way now and as you age. But it is temporary. just like renting your entire life. When it's over, you don't get to keep the house. You don't get to keep the apartment. You move on to the next one. Permanent or whole life insurance, as the name implies, is exactly that. I've got a life insurance policy that'll be there my whole life. It cannot expire, Dolores, before you do. So when that policy is getting paid, it is in force, and it's like a mortgage because you can choose how long you pay for it. You might choose to pay for it for 20 years or 30 years or until a specific age, like your term was. You might pay for a policy that says, hey, at age 70, I'm going to be done paying for this policy. And now I own it. I own that policy the same way I own my house after I pay for it. It's never going to go away. It's going to keep, in fact, getting richer in value for my heirs. And when I die, whenever it is, the policy will be there. But a term insurance policy, unfortunately, is designed, it has an endpoint, you know when it's coming. And a good term insurance policy, in my professional opinion and personal opinion, is what's called convertible. So you can take it if whole life insurance just isn't in the budget. It's not in the plan today or tomorrow. You get term insurance that you can convert to a permanent policy at some point in the future. And the nice part about that is, I know some of y'all look even better now than you did 20 years ago, right? But all of us health-wise age like milk, right? Not like wine. And so you don't want to be 20, 30 years in the future trying to buy whole life insurance with the aches, the pains, the past diagnoses, because the insurance company can go, you stay over there. We can't insure you now. But when you have a convertible term insurance policy, your health is locked in with the insurance company so that when you're ready to convert, they cannot tell you no. The only thing they can tell you is, hey, Dolores, here's what it's going to cost you now at this age versus back then, but you can 100% get it. That's the difference between term insurance and whole life or permanent insurance. And the last really important thing about permanent insurance is, and for everybody, the word permanent and whole life are interchangeable terms. They mean the same thing, the same type of policy. Those whole life policies, just like a piece of real estate, they build equity inside the policy, real cash that you can access during your lifetime, right? So that with no penalty, no restriction, no risk, that can be a great supplement to the overall wealth building picture, in addition to being a life insurance vehicle.
We have a question from Ms. Hornsby in the chat.
Okay, Ms. Hornsby, thank you.
3B and to a Roth.
Perfect. So question reads, would you take part of a 403B and convert to a Roth? So Ms. Hornsby, yes, you can. You can sometimes do that if you're still actively working. That 403B, I would reach out to the employer plan sponsor, and you may be able to convert it to a Roth 403B inside your plan. If it's money that is with an old employer, then yes, you can take that money out of the 403B and convert it to a Roth IRA. So IRA stands for Individual Retirement Agreement between you and the government. But yes, you can do that. And depending on your circumstance, right? Nothing I say today should be misconstrued as personal financial advice for any of you. It's just thought process and ideas for what you can do. But depending on your circumstance, it could be a meaningful idea to think about that conversion.
Okay, we have one in the sanctuary.
Okay.
Hi, good afternoon. My name is Shannon. Thank you, Darren, for being here, and to Paul Quinn and to Women Inc. Thank you so much for this workshop. My question is, well, first I want to say, you said if you're sitting on a lot of money in your checking account, draw that from out of there and to put it into a savings account.
Correct.
What type of savings account are you talking about?
Yeah.
I know one with a high yield interest rate, but which one?
Correct. Great question. So yes, I am an advocate of getting money into a high yield savings account. So there's Your conventional savings accounts, depending on the institution, again, this is why a banking relationship matters, right? Lots of banks have a conventional savings that are going to pay you 0.01, 0.1, 0.3% today, right? So it's really important that you go in and advocate for yourself and your money. So yes, high yield savings account all day long. You can open your wallet today and look through it. And I'm not endorsing any of these institutions, just giving you ideas. American Express, Discover, Capital One, uh, big box names that you may already know and trust from your credit experience that have high yield savings accounts. They already know you. You can open them online in 2 or 3 minutes on your phone before you leave the sanctuary, and you could transfer money and starting to make real interest today. And what I do know, and look, this is not a shameless plug for Paul Quinn Federal Credit Union at all, right? But what I do know is with smaller institutions, with local institutions, that stuff may not be readily advertised because, they've got more overhead than some of the big box banks. Their profit margins are thinner, and so they've got to guard and safeguard the well-being of the institution for the community. But if you go in and talk to your banker, they will have options for you that may not be as publicly advertised along the way that can serve you well. So either of those routes is appropriate for you to think about. And I just never want people to hear me only talk about the big boxes because community banking is so important. When was the last time you went to a workshop sponsored by Discover Bank? When was the last time you went to a workshop sponsored by Bank of America in your community at your local church? It doesn't happen, right? Doesn't happen often. So that this level of effort is happening at the grassroots level is important. And so if you can continue to bank locally with your credit union and twist their arm a little bit to get some more of that money, it's a good thing for everybody.
We have one more question. Long-term health insurance is very expensive if you don't purchase it when you're young. Do you still recommend purchasing after 70 or other alternatives?
That is a very great question. So long-term care insurance is what I'm going to redirect the question to. So Melva, let me know if I'm misinterpreting, but so long-term care insurance is like we talked about earlier. It's essentially the disability of retirement. If I'm retired and I feel confident about having enough money to live out my days, if everything goes according to plan, that's great. But what happens when I need a home health aide or a nurse to come to the house? Or I need to go to a full service nursing facility, which in Massachusetts, in my neck of the woods on the cheaper side of Massachusetts today is about $350 per day. It's $10,000 a month. In New York, it's closer to $14,000 a month for a decent place. I'm not talking about the Ritz-Carlton here, but I'm not talking about the Motel 6 either, right? But a decent place you can age with dignity, it's expensive. And so, yes, for those of you, to answer Melva's question, for those of you that are under 60 and you think, oh, it's too early for me to be thinking about long-term care insurance, that's not true. Plan for it now. You are still relatively young in the scheme of long-term care insurance planning, and your health is better than it's going to be in the future, more than likely. After 70, Melva, it can get challenging to get long-term care insurance if your health doesn't permit it. Now, what's happened in the industry? Just to give you a quick education lesson in a nugget. Long-term care insurance was a product that insurance companies sold years and years ago because it sounded cool. We knew we were going to have an aging population, and we just figured, most people, well, they're probably going to die off and not use the thing like most insurance. They underestimated and couldn't see the advances of modern medicine and how we are able to keep people around and comfortable and alive and how much that thing was going to cost. So long-term care is really expensive for the insurance company, so much so that in the last 5 or so years, a lot of companies left the business. They honor the contracts they have, but they're not writing any new business, right? So the evolution in the last few years has been this. what we talk about is freestanding long-term care insurance. The way you would buy a regular life insurance policy is the most expensive route typically, and not always the most meaningful because it's an insurance policy. If you use it, you're grateful that you had it, but if you didn't, well, you feel like you got by the insurance company, right? They took a lot of your money, you never used it, and you're mad as heck. We in church. All right. So the alternatives today are sometimes you can buy a life insurance policy. Again, age matters, right? You can buy a life insurance policy that a permanent or whole life policy that has a long-term care component attached to it that says, hey, if you live, there's money here in this life insurance policy that you can use. If you die, it's life insurance, it'll pay. But if you live and you need some long-term care, we can tap into the death benefit of the life insurance policy. So the money that they were going to pay when you died anyway, they'll start paying it out to you up front. Now, it's really important you understand this language. So like our contract at Northwestern, like you couldn't get that if you were 65 or older on that particular contract. And you'd have to think about understanding the language. Like I read one for another client with another company the other day, and he was like, well, I got that, Darren, on my other insurance policy. And I read it because reading's important. And ours would cover him no matter what his circumstance was, right? Even if he was young and he got into a motorcycle accident or something and needed that kind of care at a young age, we would pay it. The contract he has today says we will only pay that accelerated benefit if you have a terminal illness diagnosis with a 12-month death sentence, essentially, right? We think you got 12 months to live, then we'll pay it. So understanding that nuanced detail is important, but that is an option. And then the third option is more of a hybrid option that's evolved in the marketplace today, where you can buy a long-term care policy that doesn't feel like you're going to get got by the insurance company because it has a life insurance component attached to it. So you're paying for it for the long-term care. But if the long-term care is not doesn't end up, you don't end up needing it or using all of it, you don't lose the money because there's a life insurance component attached to it that pays out for your family. So there are lots of alternatives. Again, all these are really, I love these questions. They're so insightful. Talk to a financial professional. I'd love it to be me, right? Whoever you're talking to, it's a great opportunity to really dig in and deal with some of these. So I want to be mindful of our time and give us the opportunity to make some final remarks and questions. Ultimately, at the end of the day, I want to bookend with this, and we're going to have a session around this upcoming estate planning. And I love this quote. Estate planning is about getting the right things to the right people at the right time in the right way. A will by itself is not enough, right? A will by itself is not enough necessarily. A will is, as my estate planning colleague here in Massachusetts puts it, it is just a ticket to probate court. Right? It's a fast track for you to go and have to figure out what's going to happen. So it's important that you think about your estate planning and go, hey, how do I make sure that things get to the right people in the right way? And that's about beneficiary designations. An easy place to start is with your local banker and going, hey, if something happens to me, who does this money go to? Who's listed on the account? And who else has access to this account if I'm incapacitated, right? Those are questions your banker can answer pretty readily and easily. But estate planning is what we'll talk about in future sessions to just make sure that things are in good order. And for those we're in this season, a lot of you just sent off a lot of young people to college and the like. Estate planning starts early. When you turn 18 and you become a legal adult, everybody should be thinking about the beginning point of their estate plan, because if you got a grandbaby or a baby who's off to college right now and is an adult by the letter of the law, guess what happens if they're in a car accident or they have a little too much fun on a Thursday night and they're in the hospital? You don't have any access to them if you don't have a healthcare proxy document signed that you can present to a hospital somewhere in Nowheresville, USA, right? So estate planning starts early as 18. And as we move through it all, thinking about the big estate planning piece for you all in this room is how do I get my money to the people I love and care about with as little tax implication and frustration and headache as possible? And that's what good estate planning will do for you. I don't do any direct estate planning, but we are happy to introduce you to some folks in New York State and across the country who can be a resource for you in that regard. We also partner, Northwestern Mutual partners with a company called Trust and Wills that we can get you access to as well. So these are the important big building blocks of a good financial plan. And just like we've talked about good community banking through the Paul Quinn Federal Credit Union and the like, who you work with matters. Who you work with matters, right? So make sure, like when I'm thinking about my clients, the reason I stand here confident in what we're doing is because I've got Northwestern Mutual standing behind me. They are a 162-year-old company that has the strongest credit ratings of any financial firm in the industry, bar none. In fact, today we've got higher financial strength ratings than the United States government. And they can print money. Imagine that, right? And they can print money. So who you work with across all these different elements of your plan really matters. So make sure that you are selecting, asking, inquiring, and not just taking it on blind faith. The person you're with could be a great person. Sometimes they're not with a great company, though, right? And that matters because when they're gone, the company that you put your business with is what has to stand the test of time. So we've covered our questions. I do see one more, but I want to just respect time and ask Ms. Annette, do I have time to answer one question about 529 accounts?
Absolutely.
Awesome. So the question says, do you recommend starting 529 accounts for toddler grandchildren? So I need context here is important. Education. What is a 529 plan? So a 529 plan is today an education savings account. It used to be a college savings plan that was very restrictive in terms of what you could use it for. It was for college. But today, you can use an education savings plan for pre-K through 12 education. You could use it for trade school. You can use it for college. And in 2022, the under the wire, December 30th at 11 something p.m., Congress passed the Secure Act 2.0. And one of the provisions in that law that was really meaningful said 529 plans now have another special provision. Because what used to make people crazy about them is, hey, I put my money in this education plan. But if my baby don't use it because they got a scholarship or they chose a different career path, guess what happened to that money? It was locked up in there, and if I wanted to get it out, they charged me penalties and taxes to get it out. It was ugly. It was ugly. Today, those provisions have loosened up. So if you've saved for your grandchild or a child and they don't end up needing the money for a 529 plan, then that $35,000 of that money is the number today. You can convert to a Roth, so an after-tax retirement vehicle. And you can now jumpstart that baby's retirement planning and their long-term financial planning in a really meaningful way. And that has lots of good bones in it because a Roth IRA has more flexibility. They could use part of that as a down payment on a house without any penalty or taxes. They can pull out the money that you put into it and use it for starting a business or whatever they need to without penalty or taxes. So there's some flexibility built in there if they don't use it for education. And so Melva, yes, I would recommend double checking your situation, but putting money in a 529 plan for a grandbaby is such a good idea. And the other reason it's a really good idea is because as this education landscape changes and there's new regulation about lifetime borrowing limits for education, if a 529, if I have one for my kids, right? it's going to hurt them a little because when I go to file my FAFSA, they're going to ask, well, hey, what money do you have set aside for education that we could use for education? They're going to count the 529 because it's from parent to child. But from grandparent to child, there are very special provisions, and it doesn't get weighted and counted against that grandbaby the same way because you might have other grandbabies, right? And so all the money doesn't have to be designated for that one child. And there's just a lot of optionality built in there. But yes, I am a strong proponent with the changes of a 529 plan. Open one for your grandbaby. Talk to a professional because you got to do it right. It's got to be in your name for the grandbaby's benefit because you can also change that. If that grandchild doesn't need the money or they fall out of favor with you for some things along the way, because none of us know how it's going to go, you can change the beneficiary designation from that grandbaby to another one. And if you don't have any more, you only got the one, you can pass it down to anybody in the family in a really meaningful way. So you got lots more flexibility built in. It's a really great tool and strategy for building wealth, especially with the changes in education today in terms of what you can borrow. And the last thing I'll say, because this is impactful because of the demographic in the room, is you can gift a lot of money to your grandchildren and to people to the tune today of at least $19,000 per year with no tax implication to them or to you. So there's a lot of good bones in how you can have what I think of as a living legacy. Don't do everything for when you're gone and you can't even enjoy the benefit of it. I have a picture of a client of mine sitting here on my desk. We just buried her a few weeks ago. God rest her soul. And she had a lot of money. She was a humble lady. She lived a very humble life. She had saved a lot of money. And I looked at her when I finally met her, because I met her late in the game. Less than a year ago, she became my client. And I said, honey, you got to go spend some of this money. Because you know as well as I do, tomorrow's not promised. And after meeting her, her husband died within 6 months of us meeting. And she passed away in July, less than a year after losing her husband. And that money is going to her son. And we didn't get a chance to plan it all out as well as I would have liked her to minimize headaches for him. But more importantly, she didn't get to enjoy it. She didn't get to see the grandchild's love explode when said, Grandma can give you enough money to go buy a car, baby. And I could get to experience that, right? She got to experience a little bit of that, right? And there was so much more she could do. So y'all just do your families the favor of planning, communicating, and living. Live this legacy with them. It will, I can't back this by science, right? But I would argue that it will lengthen your years because of the joy you'll experience on this plane by getting to watch it manifest and happen instead of waiting until your eyes are closed. So, ladies, gentlemen, it's been such an honor to be with you today. I look forward to the next few sessions in this series that I know we're going to chat about here in a little bit. And feel free, there's a registration form that I know Miss Annette has. My contact information is readily available. I welcome the opportunity to connect with each and every one of you around your planning and how we might be a resource for you or connecting you with someone who can be. And I look forward to seeing you again in October and in November. Thanks so much.
Darren, we can't thank you enough. I'm excited. I couldn't sleep last night. I said, I know it's going to be something that we all need, and you certainly are there. What about it, everybody? Please give Darren another hand. We're looking forward to the next two sessions. The next session will be October 11th instead of October 4th, because we have a special person that we're going to support in our church on the 4th of October. So it will be Zoom, the next one. But in November, we'll be right back here, and Darren will be waiting for us and have more information to give us. We know that the Bible says that you should be wise in terms of spending of your money. And so certainly Darren is giving us that opportunity to know what it is that we need to do about our money. Thank you so much. We have now, let me thank in-house the people who made this all possible today. The tech team, though Tony Smith is not here, Tony Smith has instructed Charles Davis, Brittany Peters, and Eva Reedy. Please give them a hand. They made this all possible. We want to thank the trustees, and that's Dolores DeMorse, and the custodian for the day, Michael, because you made it possible. We want to thank the food committee that prepared our snack for us. We also want to thank our members of both Paul Quinn and Woman to Woman. You've been awesome. We appreciate you. We want to thank our founder, our dear Marion Brown, who has a word before Peggy and the pastor closes us out. Marion Brown, are you there? Are you ready?
She's on. You just need to unmute yourself, please.
Marion, unmute yourself.
There you go.
So much, Darren. Thank you to our leadership team, which is Annette and Peggy Brown, Annette Webb and Peggy Brown. Thank you so much. This is just what we're all about. And one of the things, and Peggy Brown knows this, so she's been a member of Woman to Woman since its inception also, and Annette, of course. But one of the things we say is that a woman to woman, let me just read this, woman to woman, extending the definition of the church community to include the community at large. And that's what we're about. And I thank you so much, for certainly you have done that this afternoon. And God bless you, Darren, and your family. Thank you so much. And just keep up the good work. And we look forward to October. Thank you so much.
This has really been more than I could have ever dreamed, and Paul Quinn has been talking about doing a workshop for many years, and we finally had it, and you were an excellent facilitator. We thank you, Darren, and we thank you for all the shout-outs for Paul Quinn. I did not pay him anything to say that. It was all truth. And if you are a member of Macedonia, or your family members are members of Macedonia, and you do not have an account with Paul Quinn, why don't you have an account with Paul Quinn? We offer 3.5% interest on your savings account in 2024.
What time y'all closing, Peggy?
Why don't you have an account? That's all I have to say. And we look forward to seeing you at the next session.
All right. Amen. I don't know. Can y'all see if I stand up? Darren, wonderful. Excellent. I'm Reverend Richard Bekeachin, the pastor of Macedonia.
Pleasure to meet you.
This has really been an eye-opener. I will definitely be calling you. I'm going to fill out the form, but I would definitely call you. I mean, and you're never too old to start. And, we get hit with a lot of taxes. And we can't afford, as people of color, we can't afford nobody. We need all our money. Mm-hmm. So this has just been very inspirational. It's been very informative. And we look forward to the next two series.
Fantastic.
Estate planning, can't wait. I mean, we all need, I don't care what you make, save your money. And I didn't know about this. I knew checking doesn't give you anything, but moving the money to savings is a great thing. And I always get these things from American Express about, they're getting 4% on your money.
They used to be. I don't think they're giving you 4. So go see my girl Peggy.
Well, but look, the credit union is here. You have a resource right here that you start saving your money and getting at least 3. at least, minimum. So I encourage you to, another shout out for the credit union, to Paul Quinn. Thank you, Darren. Come on, let's give him another hand.
Yep. So it looks like we're doing some. Go ahead, Peggy. Doing some wrap up.
In the package that you each got, the last page is an evaluation for Darren, and we're going to ask everybody to fill that out.
Please, yeah, I would appreciate it. I thrive on feedback on how we can continue to do this better, and also, you know, in other avenues, right? If God would bless me so richly that I could shift a major part of my life to doing this work in the community and engaging long term, you know, we are also building a team of advisors and across the country to meet folks in person where they are and virtually where they're comfortable to continue to have this kind of impact. And yes, to our folks online, you will be emailed over that evaluation form as well. So if you could, please leave your email in the chat if you want to chat it to me directly. And even a phone number, we'll be able to get that if you weren't able to pre-register. So that we have contact information and name for you. We know where the evaluations are coming from, and we can continue to grow and have impact, not just through this forum, but if there are opportunities for us to do this with other organizations, we do these talks with companies, feel free to reach out. There's no such thing as a silly question. Ask. If it's on your spirit, I challenge you to please ask, and we will do our best to facilitate and continue to have the impact. I am but one man, but I will do as much as God will allow me to while I'm on this plane.
Somebody else. You want to ask a question? Good afternoon, Darren.
Good afternoon.
Get in touch with you.
Yep. Everybody who registered, you can expect a follow-up from me, but easy while we're here. My office number directly, while everybody's writing, is 413-748-8710. I'll say that again, 413-748-8710. And my email is my name that's on the screen. So it's darren.james@nm. So that's like N like Nancy, M like Mary.com. And can I do this? I'm going to change my name so that you can see it on the screen. There's my email under my name now hovering. So feel free to reach out to us, everybody who's registered and shared your contact information. We will be in touch with you directly. For our folks online with the evaluation, for those of you in the sanctuary, again, we'll reach out directly and look forward to being a resource for everybody. And for my tech team, just so we don't lose the info, I'm just copying as we go so that I have everybody's contact info. Bear with me.
Okay, if all minds and hearts are clear, we're going to let Darren leave the space, and we're going to go ahead and end with prayer. Let us just pray. Eternal God, our Father, we thank you for this wonderful workshop. We thank you for those who have worked so hard to put this workshop together. We thank you for our presenter. We ask, oh God, that you will just continue to bless him and what he's doing for his people and for so many people who need this advice. We thank you, God, for everyone who joined us on Zoom, and those who came out to witness this in person. God, we ask that you will continue to bless the next two series, bless the tech team, and bless all who participated, that we may come again and join each other on Zoom in October. In Jesus' name we pray. Amen.
Amen.
Thank you, everybody. Thank you for coming. We are certainly pleased, and we hope you have learned something and to be able to use some information. We will see you on Zoom for the next session.
Thank you.
Oh, you calling me, I'm sorry. Oh,
Oh, up again.
oh, okay.
So, no, was that?